Everything you ever wanted to know about bonds. We're covering that right here, right now. Stay tuned. I'm Rob Tetrault from robtetrault.com, Senior Portfolio Manager here at Canaccord Genuity Wealth Management and the Tetrault Wealth Advisory Group. Today is going to be a fun one. We're looking at bonds, how they work, what they mean, what they signify. Do they belong in your portfolio? We're going to cover all that right here. Before we do that, take a sec to like, subscribe. Don't forget to follow. Press the red button and follow. You love the content that we put out. Don't forget to share your comments with us. We're always curious to hear what our viewers have to say about our stuff. So bonds, let's get right into it. A bond is a debt instrument, a fixed income instrument where one individual lends money to a government or a corporation in exchange for a future promise to pay. It's an obligation to pay. Think of it like a GIC or a term deposit, but instead of being at the credit union or at the local bank, it's with a different company or a different type of government, either municipal, provincial, or federal. So bonds are guaranteed, and they are guaranteed by the assets of the underlying issuer. If you buy a bond from Nike, Nike's assets are guaranteeing your bond. They're guaranteeing your payment. There's always a few different concepts for bonds. Let's go through some of those important concepts. All right, so bonds are typically going to have a principal amount or a face value on them. They're typically going to have an interest rate or a coupon payment, and they're going to have typically whether it's a fixed or variable coupon. Remember, guaranteed investments secured by the assets of the issuer of the bond or the issuer of the debt. If I buy a bond, the issuer of the bond must pay me back the money upon maturity of that bond. Typically, bonds will have maturity dates. So it might be a 1-year bond, a 5-year bond, a 10-year bond, even a 30-year bond. So bonds will mature at a future date. On that date, bonds become due, and the entire amount, the face value, becomes payable to you, the bondholder. The bond matures, the final interest payment gets paid, and you get your capital back. Now, most people don't hold bonds all the way until maturity because they do trade on the secondary market. They trade on the stock market or in the secondary market. So you can buy and sell bonds for different securities and different institutions every single trading day of the year. So the neat thing about that is that it provides you with the liquidity that you need. Think of it if you bought a 30-year bond and you wanted to get your capital back. Well, what if you don't want to wait 30 years to get your capital back? So bonds do trade. It adds the availability for you to convert your bond back into cash so that you could use your cash for other purposes. Companies can raise capital typically in two ways. They can raise equity. That would be a share offering where they would issue new shares and then individuals would buy those shares of their company. Or they can issue debt. And when they issue debt, they issue bonds. Companies will typically issue bonds for a couple reasons. They might want to fund an acquisition. Maybe they just want to shore up the balance sheet, or maybe there's a specific project that they'd like to do and they need to fund that with cash. They'll go and issue bonds, and then the balance sheet gets shored up, money comes in, and then they can spend that money to grow or acquire. So bonds have historically been defined as one of the two main asset classes. Historically, you had stocks and you had bonds. Bonds pay a coupon. That coupon is based on the interest rate. Now, the interest rate is the amount that's paid per annum per year, but the coupon is typically paid every 6 months. So if you have a 4% bond, your coupon is likely to be 2% every 6 months. A bond is typically issued at a par value or a face value, and that is typically going to be $1,000. So that is the amount that will mature at a future date. That's the amount that you're putting up as capital, as a loan, in exchange for a payment. How do you know what the coupon rate of a bond will be? Typically two factors. First off, the credit worthiness or the credit quality of the company issuing the bond. In other words, how safe is that company? How likely are they going to go bankrupt? If it's extremely unlikely that they go bankrupt, you will get less for your coupon. If it's quite likely that the company will go bankrupt, they will have to pay more for your money. The higher the interest rate coupon is, typically the higher the risk is for that company to default. The other factor is the time to maturity. So the longer the time to maturity is, typically the higher the yield payment will have to be, the higher the coupon will have to be, the further out you go. Shorter bonds typically pay less, obviously, unless you have an inverted yield curve. So how are credit ratings decided? Credit ratings are decided by credit rating agencies. There's Standard and Poor's, there's Moody's, and there's Fitch, and they will assign a rating to the company or the government that's issuing the bond. The higher the credit rating, the less they're going to have to pay interest rates or coupons. The safer the government or the company is, the less you get for your money, bottom line. Now, there's a whole bunch of different categories of bonds. There's corporate bonds, there's municipal bonds, government bonds, agency bonds. And not only that, but even inside the varieties of the bonds, you have zero coupon bonds where you buy it at a discount and it matures at par and you don't get interest payment. You get convertible bonds that typically have an option to convert into equity. You'll have callable bonds. The callable bonds allow the company that's issuing them to call them at par at a specific date or a specific time under certain conditions. There are puttable bonds, there are pricing bonds, all sorts of bonds exist out there. Now, bonds have historically been a big part of asset allocation. Back in the day when I studied my first course in finance, they used to have this rule that would say you should own in your portfolio roughly your age worth of fixed income. So if you are 50 years old, you should have 50% fixed income or 50% bonds in your portfolio. So that was an older adage, and I know some advisors still do this. And if they do, I would question your advisor as to why you have so many bonds. Interest rates used to be a lot higher. And when interest rates are paying 8 or 10%, and you can get an 8 or 10% guarantee with a bond, that makes a lot of sense. But when interest rates are at all-time lows and you're getting 1 or 2% for your bond, you really have to ask yourself, should I lock up money for 10 years just to get 2% return on my money for the next 10 years? Do I want to own that? Most people would likely say no. The other risk with bonds is that there is a reverse correlation with respect to interest rates and prices of bonds. The higher interest rates go, the lower the value of your bond becomes. Think of it this way. If I currently own a 10-year bond that's paying 2% per year and interest rates go up, current interest rates are 3%. Therefore, how much is my bond that's paying 2% worth? It's worth significantly less, right? Because now I'm only getting 2% where I could buy one in the market at 3%. So there's a parity equation that exists. And over time, that bond will be discounted by 1% per year for 10 years. Therefore, the bond will be discounted by about 10%. So in a rising interest rate environment, you must be very, very careful with what types of bonds you own and the duration of your bond portfolio. If you're a traditional investor and you own just a whole bunch of bond funds or bond ETFs, you're probably getting hammered here as interest rates have started spiking in the last year or so. Bonds are not good to own in a rising rate environment. As interest rates go up, your bonds are worth less. The longer your duration is, so the longer the maturity of your bonds are, the more you're going to get hurt. The reason is you have a lot more years that you're suffering with lower interest payments. So your bond is now worth dramatically less. Bottom line, you need to have short duration on your fixed income in a rising rate environment, because what you can then do is sell your bonds and buy newer bonds that are paying a lot more. I would caution you, if you're a traditional investor and you have a whole bunch of bonds and you just want to be defensive, I would take a long, hard look at your portfolio and I would have a long conversation with your advisor as to what is the purpose and benefit of me owning an asset class where the most I can make is 2% and I'm exposed to rising interest rate risk. There are alternatives to traditional bonds. There are other things you can do. You can look at other sources of fixed income, private debt. You can look at mortgages. You can look at preferred shares. You can look at music royalties. There's a whole bunch of different ways to generate a fixed amount of income with little to no volatility with an uncorrelated asset class to the traditional markets. I'm not saying nobody should own bonds. I'm just saying be very careful because it's an asset class that's often misunderstood. And if people actually knew the risk that was involved with owning bonds in a rising rate environment, most people would choose not to own it. And yet advisors out there and portfolio managers out there are jamming funds, bond funds, and bond ETFs into clients' portfolios like it's going out of style. I would say this. It makes sense to own a small portion of bonds in your portfolio for liquidity and for other purposes, but be very, very careful if you own a whole bunch of them, and be very, very careful if you have a long duration on your bonds. Yes, they are guaranteed, and yes, they provide stable income, but they're completely taxable. The income that's being generated is completely taxable. You have the exposure to risk, and you can often get a much higher yield just by owning stocks. So ask yourself, why do I own bonds? If the reason is because you simply need a fixed income stream, there are other ways to do it. If you're doing it because you're averse to the market, there are other ways to do it. And if you're doing it just because you want stability in your portfolio and you want less movement in the day-to-day, week-to-week, and month-to-month gyrations in your portfolio, I would also suggest to you that there are other ways to do it. If you'd like to chat about that, how to improve your portfolio's return using alternatives to bonds, go to www.speaktorob.com. We'd love to book a no obligation consultation with you, because here's the thing. Every year, if you have 40% of your portfolio in bonds and you're making 2% instead of 6%, you're losing 1.6% annually on the returns of your portfolio. That's a big number. Big number. On $1 million, on $5 million, it's huge. And even if it's on a small number, you're compounding that every single year. It's not just 1.6% once, it's 1.6% every year, compounded, and another 1.6 on that 1.6. So I would just caution you guys, take a long, hard look why you own it, ask yourself, and if you're not sure, reach out to us. We'd be happy to chat with you. Thanks so much for tuning in today, guys. I'm Rob Tetrault from robtetrault.com, Senior Portfolio Manager here at Canaccord Genuity Wealth Management and the Tetrault Wealth Advisory Group. Thank you so much for tuning in. I will see you guys in the next video.